Hello everyone and welcome back. I bought more MSCI. The stock has dropped significantly and I dropped on the way down here. So in this video I want to explain my reasoning why I bought MSCI and what did I sell to fund the proceed. Because before going into this earnings season, I was already a shareholder, a proud shareholder of MSCI. And after the earnings report, the stock went up and I went public on this. I made a video saying, I don't know why the stock is up. The report was decent, but nothing really amazing. So I did not buy more because the report was okay, but nothing crazy good. And then you had some worries that AI would replace the data providers, that AI will shock the financial industry. So you had the Anthropic, Opus 4.6 that will change the world, and all the data provider companies went down. S&P Global went down, FactSet, Gartner had a weak guidance, by the way, MSCI, Moody's, plenty of companies in the same industry went down, and I seized this opportunity to buy more MSCI. So I bought more MSCI at 513, around here. Okay, I did not time the perfect bottom, but so far the bloodbath has stopped for the moment, so we will see. And now MSCI has become my second largest position with 12% of my portfolio. Okay, so in this video I want to talk about what I'm doing now and what I plan to do in the future. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal with this YouTube channel is to document the journey and to teach you how to become a better investor so you can reach 25% per year. I built my track record because I only majoritarily invested in quality companies when they are at a fair price. And I believe MSCI is exactly in my sweet spot. I've followed the company for a few years now. I did some huge deep dive on the company. And out of all the companies in this industry, MSCI is my favorite. So I started buying the stock in 2025 after spring. I bought and then the stock dropped and I bought more here, and then the stock dropped more for some reason and I bought here. All the times I bought, I learned a few days after that the CEO, Henry Fernandez, bought. So you had insider buying at the same time I was buying. So it seems like for the moment, my timing is good because the management agrees with my timing of the shares. When I buy shares, it's because it's fairly valued. You have a few days of delay, and then you learn that the CEO has bought shares for him and his family. And we will see in a few days if the CEO is buying the dip right now. If the CEO has bought the dip, maybe in 1 week, maybe in 2 weeks, we will see. But I think the stock dropped meaningfully for absolutely no reason. I can show you the drawdown of the stock right now. Similarly to S&P Global or Moody's, we are down like 15-20%. You start from a high ground because the stock went up before. Anyway, this is your drawdown of the company, and I bought at 513. So this is a drawdown of 17%. And at the lowest point, you had a drawdown of 20%. It's a golden opportunity for those who do the work, actually. I think it's a golden opportunity for those who have done the work before. This is why you prepare. This is why you have a watch list and you have discipline in your process. This is a stock price we have not seen since April lows. So last year during the market correction of April 2025. And actually the valuation has gotten quite interesting. If you go to Fiscal AI, you can go to financials, ratio, and look at the price to free cash flow of the business. Here is what you have. We have the lowest valuation for MSCI since 2019. So even during the COVID lows, the lowest price to free cash flow we had was 28. So roughly 27, 28. And now we are at 25. So what happened? Basically, during COVID, the stock was expensive, and then they had a rise in ESG. They developed ESG analytics, so growth accelerated for MSCI, and because growth accelerated, the business deserved a higher valuation, a higher multiple. So Wall Street was very optimistic, very bullish when it comes to MSCI, and the valuation reached a price to free cash flow of 60. I was not invested in MSCI back in the days. The valuation was absolutely crazy. So since then, ESG turned out to be temporary. The growth rate declined. Now the business is a shrinking pie, and everybody knows this. So the growth rate of MSCI declined, decelerated, and the valuation declined also from a price to free cash flow of 60 to 40 to 30. And then look at us. Look at what we have in 2025. So here we are. We have a range of roughly 30, and when it is dropping, the price to free cash flow was 28 or 27, and now we are at 24, 25. We have the lowest valuation since COVID, even before COVID. But is the business worse? Is the business in a bad shape? Well, actually, you can look at the different segments MSCI has, and if this is profitable or not, if this is growing or not. You can look at the revenue. Look at the revenue growth rate. A huge reacceleration in 2021 because of ESG. The revenue reaccelerated to 20% growth rate and then declined. But still, the business is safe. I mean, you are talking about a business that is growing revenue 10% per year with a wide moat. Okay? Look at this. The ESG hype we had. Completely crazy. And now we are growing 10% per year, which is really reasonable. Reasonable because the margins are extremely high and growing. This is your operating margin profile for MSCI. Another reason why I am investing in MSCI and I am buying the dip. For the past decade, the business has had a DNA of improving efficiency. 10 years ago, operating margins were at 35%, and they wanted to improve efficiency, generate more cash flows, more profits. So the margins went from 35 to 45 to now 55. And look at this is still growing. And now with the rise of AI, the management is quite confident margins will continue to go up because AI can actually improve MSCI. AI first can reduce the amount of employees you have, the headcount. And I am tracking the headcount for MSCI. I can tell you that yes, the revenue is growing 10% per year, but the headcount, the number of employees is growing 2% per year. So you have a delta. You are hiring 2% more people, but you are getting more efficient, so you can generate 10% more revenue every year. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. At the same time, AI can re-accelerate revenue because AI can browse more data, gather more data, and create more custom products for their clients. This is what the management is saying. We will see in the future if they are saying the truth or telling lies to the public. But this is what they are saying right now. So, if you look at all the financials for MSCI, this is what you have. By the way, you see me using Fiscalia here. You can use my discount code in the description to try the website completely for free for 2 weeks. Completely for free. No need for your credit card. So try Fiscalia 2 weeks completely for free with my link in the description. If you look at the financials, I can use this website called Guru Focus. You are talking about the business with gross margins of 80%, net margins increasing of 40%. Look at the revenue. Revenue is the definition of up and to the right for the past 10 years. Net income up and to the right. Operating cash flow up and to the right. Free cash flow up and to the right. And the company is famous for doing buybacks. In 2025, they did one of their largest buyback program ever. They bought back 5% of their shares. I can show you on Fiscalia how many shares they are repurchasing. This is what you have. In 2015, they had an activist and the activists kind of forced them to do massive buybacks. The valuation was low. So back in the days, they were repurchasing 10% of their shares. And then the stock rebounded. And since 2016, 2017, here is the buyback program they had. Look at this. Look at this. I can show you the valuation at the same time. Ratio. Price to free cash flow. Where is it? Here. I can show you the price to free cash flow, the valuation of the business, and the amount of buybacks, the amount of shares they have repurchased. You see that in 2019, the company repurchased 5% of their shares. And then the valuation went up. As you can see here, the orange line, the price to free cash flow is going up and up and up. As we said previously, the price to free cash flow was 60. Valuation was really high, so they calmed down the buyback program. They only repurchased 1% of their shares. And then the valuation dropped. We went from a price to free cash flow of 60 to, at some point it was like 29, 30. They did more buybacks in 2022. They repurchased 2-3% of their shares. And now, as the valuation is dropping, they are re-accelerating the pace of buybacks. On a quarterly basis, this is what you have. Here we go. Here we go. Look at this. This is the buyback program. You see that the buybacks are re-accelerating right now, and the company just did a buyback program of 4-5% of their shares. And the management is very clear when it comes to their capital allocation decisions. They don't want to make a big acquisition. They don't want to be a pure dividend player. They don't want to tap into a new industry, a new market. No. They want to stay in their lane, and when the stock is cheap, they do buybacks. And when the stock is very cheap, they do leveraged buybacks. So recently, the company has taken more debt. As you can see here, the red line here, the company is taking more debt to do more buybacks. This is how bullish the management is. They are so convinced that their business is cheap that they are aggressively taking up more debt. I think the cost of debt was 5.15%. And I think that's quite reasonable. That's quite reasonable. You know, you don't want to have a lot of debt to do buybacks. And if you are doing leverage buybacks, you need to do it a very smart way, actually. How can you see if this is a very smart way of doing buybacks? One, you need a growing business or a stable business. You look at the revenue. You want the revenue to be either stable or growing. If you are having a declining revenue, it's stupid to do leverage buybacks. Well, I showed you before. I can show you again. The revenue of MSCI is growing. So we are in the first category. Life is good. This is your revenue over time, very stable, very smooth, up and to the right. Second category, do you have sustainability of returns in the long term? Do you think this revenue line will continue to grow in the future? Do you have visibility? Well, it depends. For every business, it depends. If you are a cyclical business, you have no visibility. MSCI is not cyclical. MSCI is a royalties business model. MSCI is focused on AUM, and 75% of the revenue is recurring. So to answer this question, yes, you have a lot of visibility. And if you don't believe me, I can show you. Recurring subscription, here is what you have. Fiscalia is so great. I mean, try it out. Click on my link. I can go to KPIs and show you in blue the recurring revenue, that is 70% of the revenue, and the asset-based fees, so what is more cyclical for the business, represents 25% of the revenue. So the large majority of the business is recurring, 70%. So to answer the second question, yes, you have visibility. You know that in the next 5 years, the business will grow more revenue. Okay. At the same time, as I showed you before, the business is getting more efficient, better margins. And at the same time, they want to stay in their line. So no stupid acquisition like we had for S&P Global. I believe I will release a video about S&P Global. And normally, you should be on my channel. Yesterday, I should have released the video about S&P Global. And the day after this video, I am releasing this video right now. So you can go to my old video from yesterday that is talking about S&P Global, my opinion on the stock and whether I am buying it. And I'm comparing MSCI and S&P Global. People don't really know how to compare these two companies. I'm doing some elements to help you out. So yeah, MSCI is staying in their lane and they're doing massive buybacks. They have visibility. And because they have this visibility, they can take on more debt. Because the business is so stable, growing, recurring, it's more safe to take on debt to do buybacks. And over the past decade, the management has used debt in a very smart way. Not too little, not too much. I have created a custom metric to compare the net debt of the business to the free cash flow of the business. Ideally, I want this ratio to be below 4. Guess this ratio right now. Annual, I can do annual or I can do last 12 months. Is this the same? Yeah, this is the same. Look at the past 10 years. Over the past 10 years, this is this ratio. This is my own custom metric. You don't have this on Fiscal AI. You have to create your own custom metric, which is another reason why I love Fiscal AI. The only website you can create your own custom metrics. I told you I want this ratio to be below 4. And over the past decade, the management has been quite reasonable, and this ratio was almost never above 4. You have one instance here in March 2016, and then this ratio was 3 and 3. So you compare the net debt to the free cash flow. In how many years of free cash flow can you repay your debt? This is the answer. And it was 3, 2.5, 3. And then in 2025, it was 3. And they said publicly, we want to increase the leverage ratio because we want to do more buybacks. And now it's at 3.7. One bad thing, one good thing. You want to start with the positive or the negative? Well, I'm alone recording this video. So let's start with the positive. As always, they are very smart and they are timing their buybacks. The valuation is getting cheaper, so they are increasing the pace of buybacks with debt. Very smart. But the negative thing is you are getting at a resistance here. You are getting tapped out. You are almost at 4. And historically speaking, the management is not going above 4, which means if the stock drops a lot, they will be maybe more conservative to go into more leverage in the future. Which means if the stock drops immensely tomorrow, they will not be able to buy back as many shares as they want to, which is quite sad. I mean, they don't have a lot of leeway to do massive buybacks. This is my base case scenario. What I think will happen. Maybe, it's a big question mark. They will take advantage of cheap debt. And if the stock drops immensely, they will say, screw it. Screw this ratio of 4. Let's go above 4. And now MSCI will become more risky. So yes, it's good for buybacks, but you are getting more risk to your balance sheet. With that said, you can go and analyze the balance sheet of MSCI. I don't think the debt is a major issue at the moment. People worry about negative equity. People worry about the cost of debt. I have a master's degree in accounting, so I know how to analyze financial statements and the debt, what kind of debt you have, etc., etc. I can show you the debt that the company has and how little risk you have. Because for this leverage ratio, how can I full screen? Let me scroll down. I can show you this slide so you understand very well. This is this slide. Strong balance sheet provides optionality. The moment they have to repay their debt is in 2019. So before 2019, they don't have to repay any debt. So they have 2029. I can't speak English. So they have a few years before they have to repay their debt. They have 2026, 2027, 2028, 2029, 4 years. During these 4 years, this is quite likely interest rates go down. So it is quite likely they can refinance their own debt, reschedule their own debt. So they have to pay what? $1 billion of debt in 2029. Was that $2 billion of debt in 2030, $2 billion of debt in 2031, and then small debts here and there. It's quite likely you reschedule your debt. At the same time, the revenue will grow. So it would not be completely crazy to go above this ratio of 4. I don't know if I would like this idea actually. It depends on the price paid. It depends on the buyback yield. But it's a scenario that is possible, I would say. Best case scenario, you stay at 4, which means the buyback program will continue at the same pace and not reaccelerate. Anyway, now I'm very confident in MSCI. And actually, I hope the stock stays down so they can do buybacks at a cheap price. What will happen now? Now, what are the kind of returns I expect? I can show you this. I can show you on Stock Unlock the kind of returns I expect by investing in MSCI right now. Because I told you at the beginning of the video, I have had a track record of making 25% per year. Around 25% per year. By the way, I have the proof of my performance on my website. You can click on the first link in the description. I'm showing you all the proof, all the testimonials, everything on my coaching program, the kind of people I can help, my performance, my background, etc., etc. So if you want to work with me directly, click the first link in the description and you will understand everything. I'm showing you all the proof. My profile is public. My portfolio is public on eToro. You can just type my name. Okay, let me use the Stock Unlock from the DCF model from Stock Unlock, which is the best DCF model, by the way, by far. So if you want to use this DCF model, you can have a discount code in my description also. So if you want to forecast the future of MSCI and you want to calculate an intrinsic value, how do you do it? You can go to the DCF model on Stock Unlock, the best. You can forecast the free cash flow for the next 5 years. What will be the growth rate of free cash flow in the future? That's a very good question. What has been the growth rate of free cash flow in the past? For the past 5 years, this growth rate has been roughly 14%. Let's not touch it. Let's say the future looks like the past and the business will grow a little bit. I mean, it makes sense after all. If the revenue grows at 10% per year, but you have a little bit of margin improvement every year, you have a little bit more margins, your operating margin will not grow at 10% per year, but at 12, and then you play around with some interest, taxes, etc., 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 you can grow your free cash flow at 13% per year. I mean, it makes sense, 14% per year. It's possible. And what is a good price to free cash flow for this business? I showed you the chart before. It was at 30, and then in 2021 it went up at 60, and now we are back to 25. But on average it was 30. So let's use 30 for our example. Discount rate of 10%. Dividends, let's be conservative, and let's say dividends are not growing, and the business continues to do 2% buybacks. So these are our estimates. The business will grow at roughly 14% per year. Will do 2% buybacks every year, and the business deserves a price to free cash flow of 30. If these are your estimates, then the stock is 50% undervalued, and the fair value is $800. And if you buy right now, you can expect a CAGR, a compound annual growth rate, of 19% per year. That's it. You're finished. What if you think the free cash flow will grow at 12% per year? Okay. If you think the free cash flow will grow at 12% per year, then the business is still 40% undervalued. And if you buy right now, you can expect a CAGR, a compound annual growth rate of 17%. Sounds good to me. Sounds good to me. We are talking about an exemplary business model. They are very smart in what they do. Fat margins, big buybacks. And also, what if the business reaccelerates? What if it reaccelerates after all? I mean, in the past, they had moments of reacceleration. So it's possible. Instead of growing 12% per year, they grow 15% per year. If you believe them, and you believe management team that says AI will reaccelerate our business model, AI will improve our cost, AI will improve efficiency, AI will create new models, customers. Okay, let's say 15% growth rate, and let's not touch the multiple, by the way, because it will be too bullish. If you think the free cash flow will grow at 15% per year, then the business is 58% undervalued right now. And the stock, if you buy right now, the stock can generate 20% per year. Lovely. And then if you want to talk about the ultimate bullish scenario, because, I mean, you can sense the optimism of the management team if you track their wording. I've been tracking their wording for the past decade. Now the management team is extremely bullish. And in the latest earnings call, they say the AI is a godsend to us. We will become a total AI machine. Go back to the earnings report, the transcript, you do Control F, you type this total AI machine. What if their plan is right? What if they can do it? Maybe there is a 10% probability they can do it? 15%, 20% probability they can do it? What if they do it? What if they become a total AI machine? They don't need to hire more people, margins go up a lot, and the business is reaccelerating thanks to AI. Oh boy, maybe the business can grow at more than this. Maybe it will become much more efficient, and maybe the business deserves a price to free cash flow of 35. If this is your, if the business reaccelerates to, 16%, price to free cash flow of 35, you can put random numbers here just to have a rough idea. If this is the case and you are very, very bullish and the business reaccelerates efficient, then the business is 90% undervalued. And if you buy right now, you can expect a CAGR of 25% per year. It is something that can happen. This is not my base case. I am seeing the comments I am smelling the comments from here. I'm not saying it's my base case scenario. I'm saying it's my ultimate bullish scenario of growing 25% per year. But my base case is roughly 17, 18, 19% per year. My base case, actually, if you want to know it, would be something like 12% per year. And a price to free cash flow of 30. And they do 2% buybacks every year. Yeah, that could be my base case. So I am buying MSCI today for these reasons. Undervaluation of 40% and a performance right now that is approximately 17% per year. I would be very happy to make 17% per year. As I told you, I bought the dip and it is now a big position. So I'm very happy to buy at the lowest valuation we've seen in the past 6 years. And guess what? If it rebounds from here, and if I timed the bottom perfectly, I will not buy more. I have enough. In terms of allocation, the stock will rebound immensely and maybe eventually it will become my largest position. But if we have the other scenario and the stock goes down, I'm likely to buy more actually. I will likely buy more. It's very likely I increase the position meaningfully. Yeah, this is the kind of confidence I have in MSCI. I don't plan to buy Moody's. I don't buy to plan S&P Global, as I said yesterday. But I plan to be a long-term shareholder of MSCI. Because out of all the companies in the stock market I have studied, MSCI is a company that loves their shareholders. MSCI is a company that focuses on shareholder returns, free cash flow per share, smart buybacks. They have insider ownership. The CEO is still the founder. He owns 3% of the business. You have an alignment of interests, and it is an asset-light business model with almost zero capex. So it's an inflation hedge, and you are in front of one of the best business models on earth. They have plenty of proprietary data, and maybe AI will be a risk. Maybe AI will be a tailwind. Nobody knows. I'm choosing my camp. Some people are doomsayers and they say AI will kill the business model. I'm gladly taking the other side of the coin. I'm gladly betting against these people. And let's see in the next 5 to 10 years who is right. But I'm taking a strong conviction, strong position, big position in MSCI for all these reasons. And I fund the proceeds by selling a little bit of AutoZone that is here. My portfolio is shifting away from capital-intensive businesses, and I want to invest in capital-light businesses, asset-light businesses, asset-light companies that have almost zero capex and they are doing massive buybacks. AutoZone is doing massive buybacks, but in terms of capex and capital-intensiveness, I have found better. So Maybe MSCI in the past was not cheap enough to make the arbitrage, but I believe now is a good time. So I sold a little bit of AutoZone to buy a little bit more of MSCI. And now I have a lot of confusion in MSCI. So really looking forward to seeing what happens in 2026, if they are reaccelerating, what do they say about AI, we will see. But I'm taking a big position here. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.